Good day, everyone, and welcome to this question and answer session for Sasol's Virtual Capital Markets Day. My name is Tiffany Sido, and I'm the Vice President of Investor Relations at Sasol. Today, we are broadcasting live from Sasol Place, our global headquarters in Johannesburg, South Africa, where we are joined by Sasol's executive management team. I'm very excited to be one of your co-facilitators for today's engagement, together with my colleague, Elton.
Thank you, Tiffany, and hello, everyone. A warm welcome to all of you from my side as well. My name is Elton Fortuin, and I'm the Vice President for Communication and Brand Management at Sasol. I will be co-facilitating today's Q&A session with my colleague, Tiffany. As you just heard, we have all the members of Sasol's Group Executive Committee with us, who will be answering your questions for the next 90 minutes or so. Allow me to briefly introduce them to you. In the room with us, from my left, we have Paul Victor, Chief Financial Officer, Priscilla Mabelane, Executive Vice President Energy, Fleetwood Grobler, President and Chief Executive Officer, and Marius Brandt, Executive Vice President, Sasol 2.0 Transformation. Participating remotely, we have from Hamburg, Germany, Brad Griffith, our Executive Vice President for Chemicals. Our other remote participants in South Africa are Charlotte Mokoena, Executive Vice President, Human Resources and Stakeholder Relations, Bernard Klingenberg, Executive Vice President, Energy Operations, and Vuyo Katla, Executive Vice President, Strategy, Sustainability, and Integrated Services. We also have a few other specialist subject matter experts available should we require technical inputs on any of the questions we receive today. Before we kick off, let's talk you through how we will run today's Q&A session.
Thank you, Elton. While watching today's presentations, you would have seen a message pop up on the streaming platform announcing that the facility is open for posting questions. If you missed it, let me briefly explain where you can post your questions and comments. On the streaming platform to the right of your screen, you will see a dialog box that allows you to type in your questions. Simply start typing in that field and click on the send button when you are done. You can repeat this process for all your questions. Today, we have set aside 90 minutes for the Q&A session, so we encourage you to post all your relevant questions.
That's right. Your questions will be received by our Capital Markets Day support team here in Johannesburg. This team is assisting us in sorting through all the questions that are posted so that related questions can be categorized and themed. This will help us in optimizing our time together so that we get through as many questions as possible in the time that we have available. If there are questions that we don't get to today, these will remain in our database and the team will respond to them post today's live event. We also have the contact details for Investor Relations on our Capital Markets Day website, should you wish to contact the team directly. Tiffany and I will read out your questions for our panel members. Our CEO, Fleetwood Grobler, will assist in both answering the questions and allocating questions to the relevant members of his executive team. With that, let's start with our first questions. Over to you, Tiffany.
Thank you, Elton. The first set of questions is around the climate change and environmental matters. I'll start with the first set of 3 questions for Fleetwood. First question, could we get some more detail on the 2030 emission plan? What is the shape of that decline curve? Are the costs back-end loaded or earlier? And how much will it cost? This comes from Sriharsha Papu at HSBC. The second question, please clarify the base years used for Scope 1, 2 and Scope 3 emissions, and if there is a difference, please explain why. That comes from Campbell Parry. And the last question in this set, what is the plan for the SO2 abatement by 2025, from Adrian Hammond at Standard Bank?
Thank you so much, Tiffany, and thank you for those questions. Let's deal with them one by one. First of all, I will deal with the question from Harsha. So our emission plan is enabled through an investment through the period 2024 up till 2030. So that means there is a very clear roadmap. I would refer you to page 14 of our climate change report that was published today that clearly show when the various levers that we're pursuing will be being addressed and how that will play out. So the first is, of course, energy and process efficiency, then it's the renewable energy, and then it's the preparing the plant to receive more gas. The loading of that 15 to 25 billion rand that we've indicated that we will have to spend to enable this reduction target will play out through the period 2024 to 2026-7, with about 65% of the capital that will flow from the period 2026 onwards. So I think that's how you need to think about the cash flow, but also how that loads out is very well depicted in our climate change report. With respect to your second question, Campbell, I think that is quite an interesting question, because we've got two different years that we have used as baselines. So for the scope 1 and 2, why have we used 2017 as the baseline? Now, if you would recall, 2017 was the year that Sasol had a very good run rate of our facilities in South Africa. We, that year, produced around 7.8 million tons. And because of that high output and with the associated high emission footprint, we used that as the base year, because that is giving us then a very appropriate base year to say we work from, as it was one of the higher ones. Then secondly, in terms of our scope 3 emissions, by 2019, the period, let me just put it this way, by 2017, we didn't have all the elements of the scope 3 emissions of our energy business yet fully defined and reported. We have then, through the period 18 and 19, gotten to a point where we've got a more solid base for our energy business scope 3 emissions, and that's why we have used that year, because it gives you a more appropriate year to work from, because of not all elements being defined in the prior years. I think that addresses that question. And then, Adrian, the question with respect to the SO2 abatement, what we have indicated also at the year results in August is that the standards has been promulgated by March last year. We have gotten our teams to get going on the technical solutions around that regulated emission standard. We are currently busy looking at more than one technology option. One of those options involve both SO2 and greenhouse gas reductions, and we are engaging with the Department of Environment, Forestry and Fisheries to work through those options. I think we would be ready to communicate to the market by early next year, in principle, how that will play out and what are our approach with respect to the SO2 abatement.
Thank you for those answers, Fleetwood. I'll move on to the next set of questions, which are around Sasol's portfolio. The first question, does Lyondell have preemptive rights on your LCCP stake, and would you consider selling? Conversely, would you look to buy back the stake sold to Lyondell? And that comes from Abdul Davids at Kagiso. The next question in Sasol portfolio, what type of projects are envisaged for the $5 billion growth capex by 2030? And that's from Tobile Bika.
Thank you, Elton. I'm going to deal with the first question. I'm going to ask that Paul deals with the question from Tobela. So with respect to our Lyondell-LIP JV, as I have given feedback to the market when we announced this deal, there are no preemptive rights by either LyondellBasell or Sasol. It will be based on a willing buyer, willing seller principle at fair value determined by an independent third party. And we've also agreed that the partners would get maximum potential out of this joint venture in the first 2 years of operation and will not pursue any further dilution of shareholding during that period. So I think we are very well aligned with that, and the partners are aligned to continue to maximize the ramp up of that asset, and only beyond 2 years we will then pursue on a fair evaluation in a willing buyer, willing seller principle to divest the latter part or the rest of the 50% that we currently own.
Tubela, thank you very much for your question. Maybe just to put the growth cost of capital projects into context. Remember, we said the first order of allocation is the sustenance capital and maintain capital and the transition capital. And then we've given you a sense of, based on our modeling, how much capital can be available based on our scenarios. We will obviously look at the $5 billion because it can be higher, lower, depending on how macroeconomics plays out and how well the company performs. But effectively, in terms of our capital allocation, when you start to focus then on second order, meaning that you've already then serviced your maintain capital, you already serviced your dividend, then this is really kind of the capital available to channel into growth opportunities, if growth opportunities are then what you select to invest in. The three options that we have is effectively investing in our energy business, investing in the chemicals business, and investing in Sasol Eco FT. And what we will try to do in allocating the $5 billion is, first of all, having projects that effectively compete against each other at the highest possible rate of return, at the lowest possible risk, and also projects that's typically kind of supporting the long-term strategy of the company in terms of our decarbonization efforts, but also in terms of driving sustainability in the greener future. So what we will do is effectively is making sure that all the businesses do present the investment committee with the relevant projects that meets these criteria, and then we will need to kind of shape the portfolio so that it is balanced from a risk, geography, and a sector perspective. I think it will be not good for me to give you the details of those projects as the teams are working up those projects. Safe to say, however, if you just go back in terms of what Brad mentioned in terms of the various areas that we're going to target to grow the chemicals business, Priscilla spoke about mobility and decarbonization, and Marius spoke about aviation fuels and green ammonia. All of those projects will be the projects that we typically will look at, consider, weigh up against each other, and effectively allocate capital that gives the company the best opportunity at the lowest possible risk to yield the best returns for shareholders. More will actually be announced in time. Thank you.
Thank you, Paul. The next set of questions is around our new business, which was launched today, Sasol Eco FT. I'll start with the first two questions. What sort of interest have you had, if any, in your FT as a service offering from Campbell Parry? And the second question in this theme is, upside from aviation fuels looks exciting. Can you perhaps share financials on Sasol's current Saph exposure and future potential so we can quantify the upside? That comes from Andrew Snowdon at Sanlam.
Thank you, Tiffany. I'm going to address the first question that Campbell asked. And then I'm going to ask Marius to weigh in on the question 2 and 3 that you've asked. So let's just reflect a bit on the interest that we've had on Eco FT. So I must say that there was substantial interest over the last months as we started to align our focus and make it known. We've announced the partnership with Halder Topsoe that focus on sustainable fuels and chemicals recently. I believe as a result of today, with the formal announcement of this new business unit and the focus on that, I expect substantially more interest that will be coming in from the market. So with that in mind, I would think that we ain't seen nothing yet. There's much more interest coming.
Thank you, Fleetwood. If I turn to the question of Andrew, so currently we don't produce any Saph. We do produce synthetic fuels and synthetic aviation fuels that we are supplying to the South African airport just in Johannesburg. So if we look at the future and take ourselves to 2050, and with a world demand of 7 to 8 million barrels per day requirement, and 50% of that being required for Saph, you can see that the opportunity is immense. Now, currently, obviously, the cost to produce that is higher than fossil jet fuel costs, but we see that cost curves come down significantly, and there's the opportunity that we will pursue. So from a financial point of view, we see that post 2030, 2035, that financial contribution and value pool to Sasol will be quite significant.
Thank you, Marius. The last question in this theme. Your PTX for Saph strategy is conditional on significant future cost reduction. What confidence or evidence do you have to support such cost reduction? From Alexander Bogansky.
Alexander, I think that's a very key question. So what we need to get the cost of hydrogen down. Now, the major cost drivers for green hydrogen is basically the renewable energy cost as well as the capital cost of the electrolyzer. So we are talking about certain signposts that will really enable our strategy to implement the measures to get to net zero. Now, in this case, let me cite 3 data points that would reference when that will happen. It's not on a time basis, but on a cost basis. Today, electrolyzers cost of a typical PEM electrolyzer is around $1,100 per kilowatt hour. If that comes down to around $500 per kilowatt hour and renewable energy costs approaches $2 per megawatt hour installed, as well as the load factor of your renewables fluctuate between 30 and 50%, then you start reaching below the $2 per kilogram level. So those are key signposts that we would monitor. And I believe that would be, if I look at the reports that's coming in, the assessment is that by 2030, we would be in the realms of realizing this $2 or lower per kilogram. And I've mentioned in my closing remarks today, I'm very encouraged to see, for example, the Department of Energy, the hydrogen shot, to seek to get to $1 per kilogram in 1 decade to get the production costs down of $1 per kilogram green hydrogen. I've also seen very recently, the announcement of Mr. Bill Gates and his associates that look at the Breakthrough Energy Catalyst program, where they're focusing on green hydrogen, Saph, DAC, and battery, and they put $1 billion behind that. So all of these data points seems to indicate that these outcomes is going to happen perhaps much sooner than we generally at this point think. But our thinking is definitely that it's going to happen beyond 2030, but we may be proven wrong.
Thank you for those answers, Fleetwood and Marius. I'll move on to the next set of questions, and this relates to gas. How do LNG import costs compare with current coal feedstock costs? How might that evolve in the coming years as your sources of gas change? And those questions come from both Adrian Hammond at Standard Bank and Stella Cridge at Barclays. The next question under the gas theme, when might details on the international partner and LNG gas line be available? And that is from Anthony Walker at Prudential. And the last question under the gas theme, is there enough pipeline capacity for the additional gas, or is further investment required? Who is funding the LNG infrastructure? Is it Sasol or third party, and has construction begun? And that is from Herbert Kareev at Investec.
Thank you, Elton. I'm going to address the first question that Adrian asked, and then I'm going to refer questions 2, 3 to Priscilla to weigh in on those questions. So when we did our modeling, of course, we've got extensive, robust economics when we modeled the cost of LNG versus coal, etc. I think it's not in our interest to divulge what actual cost we are modeled or what we are looking, because that's sensitive commercial discussions also we have to land the LNG. So I'm not going to go into that type of detail, but suffice to say is that we all know that at a cost of a ton per coal produced and the synthesis gas that is commensurate with that ton of coal versus a petajoule of LNG, there is a price difference. LNG is more dearer, but rest assured, we have done robust modeling to determine a wide spread of various price sets, and that is what we have reported today for the return of investment is the outcome of those input costs that we've robustly modeled.
Thanks, Fleetwood, and thanks to you, Anthony, as well. In terms of the first question around when do we get to update the market on the international partnerships, I just want to highlight that we're actually, first of all, looking at two sources of LNG importation, both Matola as well as Richards Bay in Southern Africa or South Africa. And to that end, we are quite advanced in terms of Matola, in terms of negotiations with our international partners. We expect them to probably take FID, depending on how the negotiations will go in due course. So our estimation is sometime next year, as we get to the closure of our financial results, we'll give an indication of where we are in terms of those commercial negotiations. In terms of Richards Bay, this is going to take a while. We're working jointly with the Central Energy Fund as well as government to see whether we can accelerate the developments in terms of that. I just want to reiterate again, we need the two supply options for South Africa in terms of security of supply, but also to give us optionality and flexibility for LNG importation. On the third question, if I follow through that in terms of the question from Herbert, we are discussing with partners, as I've already indicated. Sasol is not intending to take any investment in terms of any of our infrastructure going forward. However, in terms of our existing ROMCO pipeline, we've got capacity to take up to 40 petajoules additional to what we have, and anything above that will probably require some modification. And you'll see earlier on we spoke about 40 to 60, so we believe that the capex required will be very modern in terms of the total cost.
Thank you, Priscilla. The next theme of questions is around our financial targets, which Paul has disclosed earlier today. I'll run through two at a time to give Fleetwood and Paul a chance to respond. The first question comes from Wade Napier at Avior. The group is targeting greater than 15% return on invested capital to 2030. Is the 15% ROIC target also applicable for post-2030? And the second question comes from Chris Hammond at RMB Morgan Stanley. What cost of capital or hurdle rate does Sasol use to assess the investment required on the 2030 to 2050 timeframe? And should the hurdle rate be higher where tech is unproven?
Thank you very much for those questions. So Wade, let me deal with your question first. We have, and I think I've said it in the presentation, that it's for us at best at this point in time to provide clarity with regards to our ROIC targets until 2030. The world is moving, the world is quite dynamic, and we have to, from time to time, as we update the capital markets information, come back to you in terms of the progress that we're making in achieving these ROIC objectives up till 2030. Beyond 2030, and it really comes to the latter questions, is we more view it from the perspective to say what type of investments can we afford in terms of our capital allocation approach and framework. Also, what can our balance sheet afford? What is our appetite on risk? And how do you want to play and win in terms of the capital available and the returns and the cash flows and where we want to invest? A lot more work needs to happen in terms of exactly how we're going to kind of patch everything together in terms of projects, opportunities, risk profiles, and areas to invest and sectors to invest. And it will be very difficult for us to venture you in giving you any targets beyond 2030 at this point in time. Hopefully you can appreciate that. However, safe to say that we will say that all projects that we invest in that is in pursuit of growing the company, other than the maintained capital, needs to meet and beat the weighted average cost of capital, considering the risk that is associated with a specific project. I think in time we will update our ROIC objectives after that, but I think at this point in time we are more inclined to say that we have very specific investment criteria with regards to projects, especially those that will go live beyond 2030. When it comes to the second question, Chris, in terms of the cost of capital and the hurdle rates, especially for these projects beyond 2030, the way that we look at weighted average cost of capital is to take the beta of the company obviously into account, which is very much the country risk and the sector or the industry risk in which we operate. Those really kind of make up the beta, and we need to make sure that as a minimum we overachieve on that. But then when one allocate the capital and consider the individual projects, the risk associated with a specific project will then effectively kind of need to be reflected in the cash flows of that specific project in doing your NPVs. So you're 100% right. In terms of projects that has greenfield technology, the risk associated with that in your cash flows will obviously be higher, unless you have a very strong way of mitigating it, versus projects that's plug and play, that's more utility based. The technology is proven, you can operate it at scale, and those kind of risk factors that find its way into the cash flows is obviously lower compared to the greenfields risk projects. And that's the way that we look at it, and the way that we'll evaluate them projects on NPV, and in terms of kind of the various sectors in our business, in terms of the portfolios, where to allocate the capital to.
Thank you, Paul. There are two more questions in this section. Please expand on how you intend to drive cash break-even from $40 to $30 to $35 per barrel by 2030, from Adrian Hammond at Standard Bank. And the last question in this section, what assumptions have you made for carbon taxes?
So two good questions. In terms of how do we drive our cash break-evens lower, I think safe to say, and Priscilla can also weigh in on that, because a big component of that lies in the energy and integrated chemical space in Southern Africa. But ultimately, Sasol 2.0 will fundamentally contribute significantly to our cash break-evens on the South African integrated value chain. In terms of the specific initiatives that I've highlighted, such as the reorganization of the business, such as driving supply chain efficiency, making sure that we improve our margin exposure and really kind of focus on high yielding our margin offering, especially on the South African value chain, are only some examples of what Sasol 2.0 will deliver, and hence, in fact, contribute to the significant reduction in the cash break-even. Safe to say that by 2025, in that range of 30 to 35, we do expect to be at the lower end of the 30 to 35. And then in terms of the period 25 to 30, effectively, as you introduce higher feedstock, such as gas relative to coal, it will ultimately start to increase the kind of your development in terms of that range of 30 to 35. However, we do believe that looking at the cost pressures in terms of higher feedstock cost and carbon taxes that which we've taken into account, we do believe that ultimately, the mitigating factors such as further optimizing costs and efficiencies, as Priscilla also highlighted in her presentation, will allow us to keep that cost at bay. I think it's very important that we also manage the capital, the maintenance capital within that 20 to 25 billion rand range, because that also effectively contributes quite significantly to us holding the 30 to 35 range. Priscilla, anything to add?
I think you've covered it all, Paul. Thank you. Just one area that I want to highlight is in terms of our efficiency drives. As part of our decarbonization agenda, earlier on I've mentioned that we'll be reducing or shifting towards renewables. That will also come with electricity cost reductions, which will contribute to our efficiencies. Furthermore, Bernard and I are working with the team to ensure that we are driving reliability of our assets and optimizing that, and we're also deploying digitalization as well.
On the second question, in terms of assumptions that we've made on carbon tax, Adrian, I think we have shared in the past our stance in terms of our assumptions. At this point in time, there's no clear guidance in South Africa in terms of what the carbon tax effectively pricing will play out beyond financial year 2022. And hence, we did take the assumption to say, what do we believe is the South African carbon exposure in terms of carbon budget? What is our deduction in terms of our carbon profile in terms of that? What do we believe are the different projects that can create incentives for us or drive efficiency? And all of that we effectively have taken into account in assessing the performance against the budget trajectory, the carbon trajectory for South Africa. Safe to say that the carbon tax that we effectively pay today, which is around about the 1 billion rand pre-tax and 700 million rand post-tax, we do see post-2022, financial 22, that there will be a much steeper increase in the cash flows associated with the carbon taxes. But what it will be I think we still need to wait in terms of government to give us that clarity. We do believe our NPVs and our cash flows sufficiently caters for our interpretation of the carbon taxes, given all these facts into account, or take these facts into account. Thank you.
Thank you for those responses, Paul and Priscilla. We'll move on to the next set of questions, and these relate to balance sheet. Would you please confirm the triggers for a dividend? What are the metrics to track? Should the current environment persist, can we expect a dividend in FY22? I'll then also ask the next question rather. Could we also expect some comments on how you are thinking about a financial framework for transition? What's the hurdle rate for decarbonisation investments? And apologies, let me just confirm who's asking those questions. On the first question regarding dividend, that's from Herbert Kareev at Investec. On the second question about the financial framework, that is Sriharsha Papu at HSBC.
Good day, Herbie. I think we have indicated in the presentation that for the first payout, the 36% of core headline earnings per share, we will effectively focus on two triggers. The first trigger will be the net debt to EBITDA, and there we will effectively work on a ratio of 1.5 times and lower. The second measure that we've introduced, which is different to what we had in the past, we also introduced an absolute debt level, which we want to achieve, and both triggers effectively will trigger the board's consideration for a potential dividend payout. Now, the absolute debt level needs to be excluding the lease liabilities, because we don't include those in that assumption, but that needs to be lesser than $5 billion. So effectively, once we achieve those two targets, we will make a recommendation to the board. And as I've mentioned earlier in my presentation, the board will then consider the prevailing market circumstances and also kind of assess whether we can actually pay the dividend on a sustainable basis going forward, given the fact that we have achieved those two specific triggers. In terms of progress, we are making good progress. I mean, at year end, we did give you indication that we have dipped below $6 billion. And we've already achieved 1.5 times a net debt to EBITDA. So ultimately, where oil prices sits currently and the cash flow generating ability of the company, as well as the tail end of the asset disposals that still must be completed, we do believe that there will be a strong downward pressure and that will be a positive downward pressure on our absolute debt levels. So we are quite hopeful that hopefully this year or soon thereafter, we can achieve $5 billion and lower and keep the 1.5 times net debt to EBITDA. As I've said, it's not a foregone conclusion that if you achieve those triggers that the board will automatically approve the dividend. They will need to consider the market circumstances. But in a perfect world, if oil prices do hold up and there is a positive expectation of where macros may play out in future, then I think the board will consider the dividend favourably given the combination of those circumstances. I think, Herbie, what's also quite important is that the hedging policy and our approach to hedging still continues, because hedging just gives the board much more confidence that the downside is protected, and once introducing the dividend, that it actually makes good sense because there's a floor protection for it. So our thinking is very much along those lines, but so far so good. We're making good progress, and hopefully we can continue that and have a positive conversation on the dividend later during the year. On the second question, Harsha, in terms of how do we really think about the financial framework in terms of the transition, I think quite importantly, as I've mentioned earlier, the transition capital to get to 30% is part of the first order of allocation. So before we pay the dividend, we have to make sure that 15 to 25 billion effectively gets serviced, that it's part of our plans, and that capital gets allocated to that first. But then obviously, immediately thereafter, the dividend needs to be taken into account. So the rest of the projects which I then refer to as growth projects with the intention of decarbonisation of the future is very much aligned to the previous question I answered to Chris, that says that we will consider the beta of the company in terms of cost of capital. We will effectively consider the various risk elements associated with the project and what that does to the NPVs. But I will say that we are not going to follow a vanilla approach on all projects. We specifically will focus on projects to overachieve WACC, but projects that does cover a lower risk in terms of the NPVs, those projects will be evaluated at probably a lower risk criteria compared to greenfields projects that effectively carries a higher risk. But at the end of the day, it's also about balance and balancing the portfolio within the sectors in which we operate.
Thank you for those responses, Paul. I'll deal with the next two questions under the theme of balance sheet. Please rank the capital requirements as according to the following. So the 2030 energy transition, CapEx of between 10 to 15 billion rand, dividends, specialty chemicals growth, the $5 billion, and then entering green H2 production and LNG, and that's from Tubela Bika. And then the next question, also from Tubela, does the 10 to 15 billion rand of transformation CapEx include bringing in LNG to South Africa?
Thank you very much for those questions. Maybe just on a point of correction, the transition capital is not 10 to 15, it's 15 to 25. I think we've been quite clear about, setting that out for you. So that's just on a point of correction. But in terms of the ranking of the capital, as we also gave the kind of explanation in the capital allocation framework, it's maintained capital as well as transition capital. So that comes first. And we have given you the indication that our assessment is that will be between 20 and 25 billion rand per annum from now onwards to 2030. And we also believe that is needed to actually keep the company going in meeting its energy and sustainability objectives, but also making sure that it delivers a certain rate of return for us. So we're quite comfortable that capital must go there first. Then the second order of capital allocation is the dividend, the minimum dividend payout, the 36 of core headline earnings per share. And then when you then step the dividend up relative to growth, that's kind of where you get into the second order of allocation. I must say, to step up the dividend to 40% payout is not a big amount of capital. And I think if we are cash flush in the organization and we don't have such a over exerted portfolio, that ultimately stepping up that dividend to 40% should be a relatively easy conversation and decision. Once you've done your dividend, then effectively your growth projects needs to be considered. Also, buybacks and other special dividends. But let's say in this argument, we can consider when we look at the projects, that the projects outweigh the benefits of, let's say, a buyback option on your shares. Then your specialty chemical growth in the way that you explained it here, as well as your green hydrogen, will also kind of be part of that. In terms of LNG is part of the transition capital, as Priscilla explained. We don't plan to invest in LNG ourselves, but will be a taker of LNG in terms of pricing. So we don't envisage a big amount of capital, but the small amount of capital that is then associated with LNG, and then the respective infrastructure built out to link up to our pipeline infrastructure, that is part of the transition capital, and we have allowed for that. So hopefully that answers the questions, both questions that's been posed. Thank you.
Thank you, Paul. We'll now transition to the questions around the energy business theme. Can you give us a preliminary idea of how the Synfuels facility needs to change in order to transition to 100% green hydrogen, and what will it cost? And that's from Gerard Engelbrecht at ABSA. And the second question in the same category, what are the key risks to successful development of a hydrogen economy in South Africa, from Michelle Emmerich?
Thank you for those two questions. I will deal with the first question and ask that Priscilla weigh in on the second question. Now, Gerard, in terms of our thinking with respect to Secunda and the transformation, I would like to just start off by saying that, from a shareholder's point of view, we want to deliver optimal value in the decision-making and pathways as we deliver the outcome of a net zero target by 2050. So on the one hand, you can imagine there's an option or a pathway to say, just run Secunda down and close it. On the other hand, it is go big bang and just introduce sustainable green hydrogen and carbon capture, sustainable carbon. Those are the two I would say, walls of the room. But we need to operate for the optimal shareholder value in between. And how do we think about what are those pathways? So first of all, I think let's talk first about leveling the playing field that we're on. So if we take the invested plants and the products that we produce in our Secunda operations, if you want to compare that the playing field is level and you would say, how would another competitor or peer match up to produce 7 million tons of sustainable products starting from a level playing field? First of all, if I take a proxy of methanol to olefins to develop 7 million tons of methanol to olefins, also using renewable energy, talking to my level playing field, then that investment will be anything between 20 to 30 billion US dollars. In Sasol's case, we don't need to make that investment because the kit is already there to produce products. So I think that's an important reference point. The other one, with the studies that's been recently done in South Africa by the NBI for a net zero pathway of the country, IHS has also come up with a particular outcome to say that Sasol, because of our existing kit, we've got around a $200 per ton advantage to produce, for example, sustainable aviation fuels. And again, it is talking to the existing kit that can just be retrofitted. So the other metric that I would like just to position, Gerard, and you know our Synfuels operations very well, about at least 60% of the cost sits in the mining, gas preparation, rectisol up till the gas circuit. And if we go in the full-fledged outcome of a sustainable green hydrogen and carbon capture, you don't have that cost burden. That could be anything towards $1.3 billion to $1.5 billion plus per annum that you have available then to invest into preparing for example, direct air capture, etc. So that is a number that is going to be tangibly helping us to make the transition into renewables and sustainable fuels. The other part is that we've got a very flexible setup in Secunda. Remember, we've got 2 factories, we've got 4 phases, so we can basically go 25%, 50%, 75%, 100% over time. So those pathways are really very interesting for us because it gives us optionality of how to introduce it, and you can run concurrently. For example, sustainable feedstock with fossil feedstock, and you can think about all the combinations that you can manage that. And last but not least, in this way of that we think at the moment, we don't need a Sasol to invest in that full amount over time. I think, the proof point is already we will be introducing 1,200 megawatt of renewables without investing in wind turbines and solar panels to achieve that. So as we go through this transformation to net zero, we don't necessarily have to invest ourselves in that type of kit. What we do find interesting is the integrated value chain from renewables to the hydrogen, to the conversion in Fischer-Tropsch to the end product. And so in that combination, we believe that partnerships will be a key element to mitigate risk and to mitigate capital spend. And we believe that in that pathway, there's also factors that we haven't even considered yet, is the credits by taking carbon out of the air. Will that help us to fund some of these investments? The others are product premiums. Are there product premiums that will be paid because we are one of the few industries that can produce sustainable fuels and sustainable chemicals? All of those factors play in to make this pathways that we've talked about really viable, because the optionalities, the incremental investment to get to that point, the flexibility of our operations, the kit that is already there in Secunda, well invested, utilities, infrastructure, etc. is already there. So we don't need to invest, and I've seen some mooted values of between 40 and 50 billion US dollar. If that is the amount, we have not done that assessment in terms of the exact capital required to do that. But all I can say that definitely we don't need to invest in that full amount. It will be in partnership to get that calibrated to the right sized risk reward for us to go through this pathway. And I think that's just some thoughts, these points that I made, to give you a reference how we think about that and how do we see that pathway to 100%.
Thanks, Fleetwood. Amish, very good question. One of the things that we're looking at is that we believe that there are basically two pillars to the hydrogen economy in Southern Africa, and I'll go beyond Southern Africa because we're looking at the region. The first part is how do we stimulate the local market? And as we all know at this stage, and Fleetwood has touched on that as well, the current cost of sustainable products is quite expensive, so it's important that the learning curves start to drive the cost down. So that's one of the critical risks and the signposts that we'll be watching. The second element of that is that we need to have an enabling regulatory framework. During my presentation earlier, and also Fleetwood alluded to this, we have actually been working very closely with government, and we are participating in a number of forums that government has created to ensure that we can actually develop the necessary strategy in terms of hydrogen strategy, as well as a roadmap to enable South Africa to accelerate and take advantage of these changes, particularly given the opportunities we have with regard to renewables, as well as our proprietary technology, FT, that we've mentioned several times today. So that's the one part that is quite critical. The second element of that is how do we work with our customers, particularly commercial transportation and mining sector, as well as in steel, etc., the hard-to-abate industries, to ensure that we can start running some pilot tests to drive the incubation as well as to drive the demand going forward. At the same level, we're also working with a number of OEMs to ensure that we can get the right technologies and start to test it going forward. If I shift towards what does it mean for the export market, which we do believe that there is a huge opportunity for the region. The biggest risk that we see there is that all of these are likely to be greenfield developments. And as we all understand, that greenfields are quite complex, starting from the end-to-end of the entire chain. So how are we going to manage this from the feasibility, the pre-feasibility, the feasibility, the development, and the operations? The great thing is that Sasol brings in that experience of running very complex businesses, as well as developing those complex projects and bringing a number of partners. And we do recognize that we don't necessarily have to build capability across the entire ecosystem. So we'll be bringing a number of partners. We've demonstrated that in all our projects in the past. So we are quite advanced in some areas in negotiations and discussions with partners to be able to enable that. And then there are other complexities from a regulatory perspective, such as environmental, that we need to manage appropriately, working with stakeholders and communities. So all of those are well outlined, and we've got a very comprehensive plan and program to address all of these issues going forward. But at the end of the day, it's going to be, can we be competitive as a region to some of the other emerging markets such as Chile and Australia? Thank you.
Thank you, Priscilla. There are a few more questions in this on the energy business. The next question comes from Chris Nicholson at RMB. Please elaborate on how you will maintain return on invested capital through to 2030 at FY25 levels. How can this be given the carbon tax challenge and more expensive gas feedstock, and what further savings are required? The next question, can you please tell us more about the carbon captured feedstock? Are there any pilot projects in test, and can you tell us more about the specific technology? From Anthony Walker at Prudential.
Thank you, Tiffany. I will deal with the question from Anthony with respect to the carbon captured feedstock. Very interesting developments there. And I may ask Marius also to weigh in on that specific thing, because we've been engaging over the past month or so with some of those vendors that's busy with carbon capture. But nonetheless, with respect to your first question, I'm going to ask Priscilla and Paul to weigh in on that.
Thanks, Fleetwood. Paul, you can add as well. As Paul indicated earlier on, in terms of our modeling and the assumptions we've used, they're quite conservative. So let's just take an example. In terms of carbon tax, we've actually looked at the NDC, which has now been issued, and we were quite impressed to see that our GHG reduction target puts us at the top end of that NDC. So our expectation is that our modeling has actually been run on extremely conservative approaches, because we've actually assumed that we'll probably keep below the budget, but at that stage assuming a very aggressive reduction against the NDC. So from that perspective, we do believe that our modeling and the ROC that we are showing is quite reasonable and can be achieved. And secondly, in terms of gas feedstock, Paul has also mentioned as well, so we've really run different scenarios, and our base scenario also again use very, very high assumptions around gas and testing it against different macros. But our expectation as well is that we should actually deliver better value than what we've modeled. But at this stage, we can't really disclose, because all of this are still very much subject to commercial terms and very sensitive. But overall, we have also continued to identify efficiency drives beyond the Sasol 2.0 cost efficiencies we've outlined, and we are tirelessly working towards that. And we've demonstrated beyond just the transformation of the organization in terms of workforce reduction that we can actually deliver sustainable efficiencies. Paul, do you want to add?
Yeah, Priscilla, I think you said it all. Maybe a couple of touch points is that there's a strong drive in the energy business to ensure, and just remember the ROIC is affected by on the earnings side, that we do want to kind of be much more aggressive on the retail side and driving our mobility business. And we do know that, given our product offering, we can actually demand a much higher margin in that type of business. And Priscilla also highlighted that in her presentation. We believe that there's much more value there to capture, and ultimately that channel much more gross margin into that business, and ultimately gives you a good foundation on the ROIC. The fact that we can actually hold our sustenance capital within that band and also conforming to the 30% target is also, I think, quite positive. And then, as Priscilla also said, I think as you think about 2025 to 2030, it's going to be much less coal, and we are introducing gas. So you have to then weigh up that I'm paying more for gas, but what is the knock-on impact of paying less, or in terms of taking in less coal? So we've done those assessments, and effectively a combination of much driving higher margins, holding your sustenance capital, and as Priscilla says, kind of conservative assumptions in what we believe, the net is on gas versus coal. We do believe that those targets are very much achievable on ROIC.
So let me deal with the question of Anthony. So the term that we generally use in the industry is DAC. Now, we should not confuse this with carbon capture and sequestration, which is also a technology that's been practiced. So to capture the CO2, to sequester it, the US is an excellent example where there are pipelines of CO2 that is then be dealt with, and it's sent into wells or back into reservoirs where it's kept forever and a day. But that is a source of CO2 as a carbon source for us. DAC specifically is direct air capture of CO2. And we believe that is a technology that would be useful to see the development as that comes down the learning curve of cost. We believe if DAC becomes cost affordable around $200 per ton, that would be very interesting for us, both in eco-FT as well as our current synfuels operations. And that is really a technology that we believe will hold the promise to decarbonize fully over time. I will defer to Marius for our recent engagement with some of these vendors.
Thank you, Fleetwood. Specifically, there's a couple of large emerging suppliers in this environment. These suppliers have, in recent time, one of them have just launched a pilot project, which in the order of about 4,000 tons per annum of CO2 will be extracted. They will be using a dry amine solution to extract that CO2. And as Fleetwood has said, that cost will now start to come down. It's also dependent on renewable energy pricing being more favorable into the future. Now, I think this is not the only company that is doing that. There's a number of others, and we will be engaging with those also in due course to complement EcoFT, but I think also very important for the South African solutions that we are pursuing in this regard. In the meantime, as we are looking at EcoFT opportunities, we are obviously looking at biomass. We are also looking at, unavoidable CO2 sources to bridge that gap almost until we see that cost curve for direct air capture to come down to, as Fleetwood indicated, below the $200 per ton. So I think very exciting space this to look forward to, and I think we believe a real opportunity for Sasol to be engaged with.
Just as a reference, Marius, to add perhaps that in the energy business, our carbon need is around 2 million tons of CO2. If we can get that captured through this technology, and we can get the 2 million tons of green hydrogen, then we've got all the feedstock we need to replace all the gas and coal that we do today. So it just gives you a sense of how much CO2 through the DAC process and how much hydrogen green we need to replace all feedstock that we use today.
Okay, thank you for those answers from the panel. We'll move on to chemicals as our next theme. The first question from chemicals, and this is from Herbert Kareev. What is the status of the US business after Hurricane Ida? Is it business as usual? I'll ask the second question under this theme as well, and that's from Sashank Lanka at BOFA. Chemicals Africa returns are going down due to higher priced gas feedstock. What is the longer term outlook and strategy for this segment? And the third question under the theme of chemicals is from Simon van Rensen. Should Sasol not pursue the recycling of segregated plastics waste, specifically in Southern Africa?
Thank you, Elton. I'm going to ask Brad to weigh in on these three questions. Brad?
Thank you. Thank you for the questions. First, going to the question around Lake Charles and Hurricane Ida. So we were very fortunate for our Lake Charles site to be west of the track of Hurricane Ida. It unfortunately went into the area around New Orleans, Baton Rouge area. So our facilities were unaffected, and we've not really seen any impacts to our business from this year's storm situations. In terms of your questions, Sashank, thank you for the question on the Chemicals Africa returns. I think what you heard Paul indicate was that we built in a fairly conservative price deck in terms of evaluating the impact of the ROIC on the Chemicals Africa. And really, as we make that energy transition and the transformation of our business in Southern Africa, we will be looking at the price premiums that can be achieved through more sustainable chemicals, as well as understanding our cost competitiveness, the asset reviews, the things that we normally do to be able to pursue cost and capital reduction efforts, as you also heard Priscilla commenting on for our energy operations. So I think that's important to understand the context of that, and we'll update that as our plans progress further. And thank you, Simon, for the question around plastic waste. It's an important element for Sasol's plans in Southern Africa and also for the plastics industry. You're probably aware that South Africa has a Waste Management Act that's just recently been put forward with updates on aspirational targets, and we certainly are participating in that as part of the industry associations and also work that we're doing on plastic waste recycling demonstration projects, and also helping with the segregation of waste. So it's absolutely a priority. And we also see the opportunity to pursue the potential for chemical recycling of those wastes as they've been segregated that can create feedstocks, as I referenced in my presentation. So we absolutely see that as an imperative for the country and for the region, and also as an opportunity. Thank you.
Thank you, Brad. Moving back, there was another question on the gas opportunity. I'll then move to some more general questions which are coming in from the portal. On gas, the question comes from both Adrian Hammond at Standard Bank and Stella Cridge at Barclays. How does LNG imports compare with the current coal feedstock cost, and how might that evolve in the coming years as your sources of gas change? I think let's deal with that question first, Fleetwood.
Thank you, Tiffany. I think we've started off with that question in terms of, how it compares, and I've given our view on that and how we have modeled that. So I'm not going to repeat that answer. What we do believe is that in the long term, the cost of gas, it is like the view on oil price and the linkages with oil. So when we look at the real $55 oil world, we believe that that is also the commensurate tight gas world going forward. And I think, your crystal ball is as good as ours to say how would that change in the coming years. All we know is that, the world is volatile, prices go up. We've seen the recent spike of gas being used in Europe and other areas. But we believe those are the volatility of the market that we live in. And as oil price a year ago was also approaching zero and rebounded back within 12 to 18 months to where we are today, those would be also foreseen within the gas price markets. But we do believe that the outlook that we've got tied to the oil price is robust in the world of decarbonization going forward.
Thank you, Fleetwood. Another question from Wade Napier. Did any of your scenario analysis trigger an outcome where Sasol would need to walk away from Secunda? And a second question along the similar theme, have you assessed the competitiveness of FT versus other technologies to produce sustainable fuels as you venture into Sasol Eco FT? And that comes from Gretchen Rudolph at ABN AMRO Bank.
Thank you. I would deal with the first question. I'm going to defer to Paul actually on the scenario analysis with respect to Secunda. All I can say that I've already mentioned is that when we look at the asset value to be used in terms of an optimal shareholder outcome, we believe there's still a lot of value in Secunda. But I'm going to ask Paul to weigh in as well.
Thank you, Fleetwood, and thanks, Wade, for the question. From a scenario analysis perspective, one needs to look at the breadth of options in Secunda, and of course, a turn down, option from a scenario planning perspective, you have to consider. Because you need to look at your other scenarios and say, as you start to allocate capital, does it actually make sense for a shareholder? And do you actually grow value by allocating capital in a sense that it meet and beats the turn down option? So definitely in terms of scenarios, we've looked at the whole breadth of scenarios. We've discussed those with the board. And I think what really helps you, Wade, is it gives you a sense of, what is needed and what proof points you need to achieve in order, for you to sanction projects, in order for them to add value and for them to be part of the longevity and sustainability roadmap and framework for Secunda. So we're very clear about, kind of what the ebbs and the flows of those are. But as Fleetwood said, that really informed our thinking of the art of the possible, and can we actually, convert Secunda in a very values-driven way for shareholders and stakeholders, and we do believe that to be the case. But obviously, much more work needs to happen in the years to come. This will not be the last time that we'll be discussing our options, the scenarios, and how the world around us change. But we do believe that the opportunities really outweighs the risk at this point in time.
So on the second question, Gretchen, there are two lenses into your question, and I'm going to ask Marius to weigh in. But I do want to just position that our Fischer-Tropsch technology compared to any other new startup, and there are quite a number of newly announced startups that claim that they would use Fischer-Tropsch to monetize some of these opportunities. I just would like to position that Sasol has got 70 years of practicing this technology. We've got various technologies implemented, scaled up, commercialized, and run. We've got various facilities all over the world. We've got different operating modes of Fischer-Tropsch, high temperature, low temperature, iron-based catalyst, cobalt-based catalyst. So I just would like to position that from an FT perspective, applying it in this application, we've got unrivaled experience. And I think that's the fact of the matter. With respect to FT in this specific application, I'm going to ask Marius to give some perspectives.
Thank you so much, Fleetwood. If I just, Gretchen, come to your question and looking at other technologies, I'm just going to give you perhaps two lenses that we've looked at. So if you compare our FT to liquids solution versus perhaps a methanol to liquid solution, certainly we see this FT route to be, from a capex point of view, very much more competitive. We're seeing improved energy efficiencies using the FT, but more so perhaps, a very important one for us, selectivity. And I think really if you look at what we want to achieve here is produce Saph or e-kerosene, as has been commonly also referred to. Our yields through FT technology application is significantly better than you can find through the other technologies. We have a catalyst that we're looking now at that can give you a yield almost nearly in excess of 80% e-kerosene, which is really fantastic in terms of the solution that we are pursuing. But then also we have to be quite open to the bio-based opportunities. And we know about HEFA, we know about alcohol to jet. All of those are very important also, but they are limited in terms of feedstock. And I think if you look at land and water availability going into the future, they need to contribute, but it's a limited contribution as we see, and also the market assesses that. So I think it's a case of we need HEFA, we need alcohol to jet, but more so, we need that PTL, that power to liquid solution. And this is specifically where Fischer-Tropsch and the Sasol Fischer-Tropsch solution can make a big difference to decarbonize those hard-to-abate industries that we are pursuing. And being sustainable aviation fuels being a primary focus for us at this stage.
Thank you, Marius. One last question from my side. Any changes to the asset lives or write-downs as a result of today's plans? And that comes from Alex Comer at JP Morgan.
Hello, Alex. You like this question, so let me give it another go. So in terms of the write-downs, we did say during the year-end results, we did take a significant write-down on the South African value chain, per se on the areas in Chemicals Africa as well as on the fuel side. And those were really informed what we articulated at that point in time, realistic conservative assumptions of what we believe the world is going to be in the next foreseeable future. But what we did articulate at that point in time is, because you haven't taken FID on certain projects, that ultimately you cannot build the benefit of those projects into your NPVs at this point in time. So we do believe that from a write-down and a net asset value perspective, we have left ourselves with sufficient headroom compared to potentially catering for any significant macroeconomic shocks, as well as the maintained capital and transition capital investment required for us over the next couple of years, as well as dealing with a lower oil price and lower margins going forward. So all of those are currently being catered for within our NPV or net asset value for the energy business. We do believe going forward with these projects discussed, and as they get sanctioned and they start to contribute future value, that it will ultimately a positive catalyst for introducing more value. And as Priscilla also indicated earlier, the value contributions that we envisage to realize in the energy business over time in the next couple of years, I think will also be a positive catalyst in introducing more value on the NPV side, just looking at write-downs. So this doesn't require any further write-downs of the business. On the contrary, I think we've been quite realistically conservative, as I've said, left us enough headroom, but we do believe that as these plans get executed, there will probably be more a push to the upside as to the downside. It doesn't take away that the world is volatile, and if we do move substantially lower, in terms of our $45 oil price case, then ultimately write-downs may come into play. But we don't see the world from an impairment perspective or fair value perspective necessarily being that low. So we've taken the $55 world into account. Those inform our net asset values at this point in time, but our plans do indicate further value upside if these plans get sanctioned and they start to roll out and earn their own living. Then secondly, in terms of asset lives, I think the one that we can quickly jump to is obviously mining, because we do indicate that ultimately our dependency on coal will reduce over time. We again looked at that, and we don't believe it's necessary to actually change the useful life. Our reserve base go until 2043, but as you know, you don't produce 40 million tons right up to the end of 2043. There is a declining curve associated with that. Those we've taken properly into account, so there's no change to the mining asset life. On Secunda, we don't anticipate to change that asset life at this point in time. Given in all the scenarios that we run, we do believe that there is a future for Secunda leading to 2050. Obviously, we will stay very close to that fact, but we do believe that ultimately there is a higher probability for Secunda still to continue to operate until 2050. On Sasolburg, we have made that decision to ultimately limit the asset life in Sasolburg to 2030 and 2034. We ultimately, I think if one look in terms of Sasolburg, the whole Natref asset, as well as the potential contribution of green hydrogen to the Sasolburg site, may warrant us to change and assess those useful lives once capital projects are sanctioned to actually extend the life, but it will be based on a positive sanction on capital projects. And I think in the US and in Europe, we actually don't need to do anything. Those really stand as we articulated them at year end.
Thank you for those responses, Paul. We'll move on to the next set of questions. The first one from Sashank Lanka. Seems like a lot of actions for ESG reduction targets till 2030. Could they have been carried out earlier, and any reason for these not have been done earlier? And I'll also then ask the next question, is the 1.2 gigawatt in renewables funded from the Transform Capital or by third parties with Sasol as an off-taker?
Thank you, Elton. So the first question from Sashank. I think, we always have been very clear that our transition from coal to gas to renewables was reflected in our first climate change report, as we say, reduce, transform and shift our portfolio. The thinking has moved on. So a year or two ago, we were really relying on the development of a north-south Rovuma pipeline that would bring in ample gas to the southern part of Mozambique and into the region and also into southern Africa. When we looked at that and the viability and the timelines, and the defining topic of this year is ESG, and the pandemic has exacerbated that in terms of the realization of impact of climate change, pandemics and others, weather events into the world we experience. And so we've also progressed our thinking. And therefore, when we look back now, we have bring in the optionality of LNG in addition to our resources in the Bapanda Tamani area. And that's why I think we've crystallized over the last 12 months now, or more recently then, these optionalities and made very, very good progress such that we can come up with these targets today. So I think that's the honest development of what transpired. With respect to Herbie's question, will the 1.2 gigawatt or 1,200 megawatts be funded from the Transform Capital? Actually, we are doing those on a product offtake type of arrangement. So we enter into commercial contracts with those suppliers who will then invest on their side, but we secure the offtake of the supply of those renewables into our facilities. So that's how we deal with that one.
Thank you, Fleetwood. The next two questions I'll now be asking. So the first one is from Alex Comer. Alex says there's not much mention of Natref. Will it be shut down? And then the next question is from Grant Macmillan. And Grant asks, LCCP could be hit by bigger climate events. What have you done to reduce this risk for the next 10 years?
Thank you, Elton. For those two questions, I'm going to ask that Priscilla reflect on the Natref bit, and that Brad reflects on the question with respect to climate events in the US.
Thanks, Fleetwood. With regard to Natref, a decision has not yet been made. What we've done, though, is we have modeled an the assessment, the impact of the CF2 on NATREF. We do know that today, without any compensation or remuneration framework, it is not viable to upgrade NATREF. Having said that, we are running multiple scenarios to see what optionalities do we have to convert NATREF into a sustainable refinery, depending on demand going forward, and we're in discussions with our partners, Total. Thank you.
Thank you, Priscilla. Brad?
Yes, thanks. Grant, thanks for the question. Obviously, it's hard for us to predict weather events, but what we can do is to constantly make sure that we're ready for them to avoid interruptions of supply. If you look back to the year 2020, when we did see 2 hurricanes that came through the Lake Charles area, we actually suffered very minimal damage within our own site. The biggest impact was due to electrical infrastructure. And the same thing we're seeing in the region around New Orleans and Baton Rouge, where Entergy is having to replace a lot of the high voltage pylons, which had been installed for decades. So I think we continue to engage with our utility suppliers. I think a lot of those were replaced in our area during the restoration following the 2 hurricanes. And so that would give us some comfort that those are more updated and modern pylons installed. At the same time, in terms of business interruption, we continue to work with our customers to see how we can forward place product prior to hurricane season, so that in case there's logistics disruptions, things like that, we can give them the security of supply that's possible during those uncertain events. So we do take it seriously. We don't like the interruptions, but fortunately, as I mentioned, we had very little damage within our own site, and so it's more about our response to that and taking care of our people. Thank you.
Thank you for that response, Brad. We now move on to our last question, which has come through on the portal. And this question comes from Chris Nicholson at RMB Morgan Stanley. The question is, could you elaborate on the approvals required or potential regulatory issues, for example, NERSA or the Eskom grid wheeling requirements with the rolling out of the 1,200 megawatts of renewables?
Thank you, Elton. Thank you, Chris. I believe that I will just make the following remark before I ask Priscilla to weigh in on what our teams are busy with at the moment in terms of those engagements. But suffice to say that the intent or the ambition of the first 600 megawatt, we all along engaged with government, and that would have been on that level on a project by project basis. We know that at that time there was only a regulatory framework for 10 megawatt of embedded generation. That has subsequently now been increased to 100 megawatt. So theoretically, you can almost put 12 of those together to get that ambition fulfilled. But of course, there are still the wheeling and the transmission issues that we need to deal with as we get those supply agreements in place. Priscilla?
Thanks, Fleetwood. Just to add as well on the NERSA, we welcome the recent decision to increase the self-generation to 100 megawatts, and we're quite advanced in our discussions with NERSA on that, particularly for the first phase, as Fleetwood mentioned. I think secondly as well, we've gone through the first phase of our RFP, and what has really been quite encouraging is that a number of the projects that have come through are actually shovel-ready, which means that most of them already have connection arrangement with Eskom. Nevertheless, we are in progress discussions with our partners, early kit with Eskom, to ensure that we can actually get the required wheeling arrangement and an agreement with Eskom. We are concerned, however, that when you look at some part of our country, such as the Northern Cape, we certainly do not have sufficient transmission system. These are discussions that we currently having with both Eskom as well as government. But to achieve 1,200 megawatts, we have the confidence with the projects that we are assessing that we will be able to deliver that.
Thank you, Priscilla. We have now reached the close of our Q&A session today, and we'll be wrapping up shortly. To help close out today's event, I invite our CEO, Fleetwood Grobler, to say a few words.
Thank you, Tiffany. And on behalf of the executive team here at Sasol, I would like to convey my appreciation to everyone involved in the many, many months of hard work that culminated in today's engagement. I would like to thank the Sasol board and my fellow executives that you've met here today virtually for the sterling work that they've done with their business teams, developing the strategy, refining it, and getting us to the stage where we can communicate that to the market day, Capital Markets Day. Also, our business teams at the back and investor relations and communications and our service providers, consultants, and everyone that made this possible. This was truly a fantastic team effort, and I just want to thank from the bottom of my heart everyone involved again for a sterling effort that culminated in today's event. I would also like to convey my appreciation to all our stakeholders who took the time out of your busy schedules today to join us for today's Capital Markets Day event. Team Sasol is very excited about the updated strategy. As you have heard, we have a compelling investment proposition with a clear vision to decarbonize our businesses and preserve also shareholder value in doing that. Our ambition is to grow shared value while accelerating our transition, all of which is guided by our purpose, innovating for a better world. Thank you once again for joining us for today's Capital Markets Day virtual event, and my team and I look forward to continuing our discussions with you in the days and months ahead. Thank you.
Thank you very much, Fleetwood. That brings us to the end of today's proceedings, and as mentioned before, if there are any questions we did not get to today, these will remain in our database and we'll respond to them after this live event. As a reminder, a copy of the presentations from today's event, as well as some supplemental material, is all available on the website. I refer you to the contact details reflected on the screen now for our investor and media relations teams, should you wish to contact the team directly. Thank you once again for your participation. We wish you all a safe and wonderful day further.